Andrew Brenner's with us, head of international fixed income securities at Nat Alliance Securities. Thank you so much for being here. I'm not going to rehash the play-by-play of yesterday. What did you think of it?
I thought that the statement was very hawkish. The fact that they dropped from 4 dot plots, 4 cuts in 24 to 2 was very negative. I thought Powell was going to reverse that when the first thing he said was the full effects of tightening have not been, we have not seen the full effects of tightening. But nonetheless, Powell went on for a more moderate, middle of the road type presser, and the market just looked at the higher for longer. The Wall Street Journal has an article this morning saying higher for longer, maybe forever, that kind of thing. And Bloomberg called bonds toast. So I tend to think that we're reaching a bottom when we see these kind of things. But what we've seen today is even more interesting. The Swiss National Bank came out this morning and said, we're done tightening. That's it. What we've done is more than enough, and we expect inflation to come down. That gave a bid to the front end of the yield curve across the world. And as we look at 2s, 10s right now, they are steeper by 10 basis points this morning alone. And 2s, 30s are steeper by 14 basis points, which means the 2-year is up on the day, and the 10-year is down 7 or 8 basis points, and the long bond is down 10 basis points. So we're seeing a real steepening of the curve, and I think that's going to continue, because I believe also with the Bank of England, who had a 60-40 chance of raising rates today and they didn't, it tells me that central banks are very concerned about raising rates too much, and Powell is absolutely in that camp.
Yeah, so, I've been hearing more and more about this bear steepening.
That's right. And I think it's gonna. I've called for it here. Steepening, and it's been back and forth. It's been down to 65 where it is right now. I'm talking 2s, 10s to 80 yesterday at the reverse of that. But I really think the 200-day moving average is 71. I really do think we're going to go to 59 and maybe even into the high 40s. So I really think it's going to change.
It was interesting because the idea and the takeaway obviously is that they can have a soft landing. That was a plausible outcome, and that if you don't have a recession, then you don't need 4 cuts next year, and that's why we're looking more at like 2 or 3 cuts. And we look at the real rate because we have to, sort of take into account inflation, right? So you have the nominal rate minus the inflation rate. So tell me a little bit about that and how folks may have to adjust. I mean, they're still paying credit cards. They're facing student loans. Mortgage rates are at these highs. He noted that yesterday, and we saw slowing in the housing market, and that business spending, too, is under pressure because rates are higher.
All right, so let's break it down. You're asking 2 questions, one about real rates and one about the economy. I'm going to go to the economy first.
Great.
I tend to think things are slowing down. I still don't see a recession. I get from Citi, the proprietary Citi credit card data, and it continues to show 10, 12, 13% downticks, and they see an increase in defaults. And then you add in the student loans that started paying the beginning of this month. I really think we're in for a slowdown. But the Fed has reversed a lot of things. They've reversed their unemployment from 5% to 4.1 now basically to 3.8 where we are right now. I don't think that's going to be sustained. I think it's going to go higher. The Fed, upped their GDP for 23. Well, 23 is almost over, so I don't think that's a big factor. I still don't see a recession, but I do see a slowdown. As far as your idea of real rates, and the Fed has no reason to ease. Real rates are too high. When I looked at 10 years coming into the New York Stock Exchange, they were 207. That's the highest I've seen them in 15 or 20 years. 5 years were 235. Again, that might be the highest I've ever seen them, but I have to go back and look. Real rates are way too high. The Fed knows that. Powell knows that. There's no reason to keep rates this high, this long. And as far as what the Fed will do, they don't have to ease just because of a recession. They can ease because they see inflation getting better, and that's what real rates are telling us. So I tend to think the Fed is going to lower rates more than twice next year. I still think they're going to lower rates 4 times. But
really?
You know what? In a slowdown in the economy, I'm still bullish on the short end of rates. I've never gone beyond 2 years. I've been in bills. I've been in 18-month paper. I've been in 2 years. I stayed away from the duration aspect, and now I have to admit, with 10 years getting close to 4.5, it's looking much more interesting. But the charts are still negative, but we'll have to wait to see what happens. So I would think get these yields in, buy stuff. Corporate spreads are still steady, good issuance. So we still think the world is okay.
Yeah, I mean, and you do expect for inflation to continue to come down year after year, just like the Fed does, right?
Absolutely.
I mean,
no
that's
question
the sort
about
of
it.
Playbook that's happening. It's still high right now. I mean,
it's still high.
It's
People
still
focus.
hitting folks. We
People
have
focus
$90
on oil,
Yeah.
right? You know, and I
Yeah.
said in my commentary yesterday, you know, I go back and forth from Maine to New York all the time, and the midpoint is Sturbridge, Mass. I always stop at the pilot station. For the last 3 months, every time I go in, it's 359. I went in 2 days ago, it's still 359.
Oh, that's
so oil's
good
gone
news.
from 68 to 91, and that gas price has stayed the same. So it isn't all filtering through. I think it's more technical. And even though Goldman says we're going to have Brent at 100, I
Yeah.
don't see where that's particularly significant. I think we'll be just fine.
And what do you tell folks who, you know, I'll ask you a double question. Households, what should they be doing with their money? Should they be saving? Are you nervous at all, cautious? And what about investors who want to put money to work? I know you can't give exact stock market advice, but you were talking about, you know, your outlook on fixed income.
Well, let's again, 2 questions. So let's go to the second one first, stocks. September is a horrible month for
Yes,
equities.
historically.
You know, as much as we've seen equities bounce back a few times, where it looks like we're going to go out closer to the lows rather than the highs. So I would stay aside on equities until the month is over, and I would look at equities in October. You know, as you said, 43.50. I look at 43.50 on the S&P futures, not the S&P cash. But I tend to think that might not be a bad entry point. As far as what to do with money, hey, I'll tell you the same thing I tell the boards that I'm on for charities and so on and so forth. 6-month bills out to 2-year notes. And the 2-year notes is more recent, with 2-year notes going above 510. I would, as long as they're above 510, I think you add, and you can get 540 in December of 24 treasuries. Look, bottom line is short treasuries is the place to be. It's safety. You know, it's better than your banks. It's higher yielding than your banks. Move your money out of banks and put them into treasuries.
All right, Andrew Brenner, Non-Alliance Securities. Always glad when you're here, particularly right around the Fed, because this is the big breaking news, and then we have to sort of interpret Fed speak sometimes, right? Thank you very much. Wonderful to have you, as always.